Welcome back to Inside Options. Today we're talking about volatility and how important it is in, well, working out implied volatility, isn't it, James? And you were starting to talk about something called goal seek, which helps one work that out.
Exactly. So we may have a predetermined idea of what we want the premium to look like. So we can use goal seek in Excel. It's this really, really cool function that allows you to change one variable in a complicated formula and kick out exactly the right answer. So if we wanted an option to be worth, say, 10 Rand, we could goal seek the correct implied volatility that we'd have to put in there to get that option to be worth 10 Rand.
Okay.
So implied volatility is really, really important because it's the main way we can tell if an option is cheap or if it's expensive. Problem is it's a forecast, so we can't really tell whether it was cheap or expensive until that option is actually expired, because we're forecasting a rate of change over the life of the option, and the higher that implied volatility is, the more expensive that option will be. The lower the number is, the cheaper that option will be. So what we want to compare it with is what actually happened over the life of that option. The other thing is also over the life of the option, how have forecasted volatilities changed? Where are people now trading them? So this is quite an interesting, important graph to have a look at. This is the JSE Top 40. It's the major index that we trade in South Africa, and it's historic volatility. It's implied volatility over time. And we go back to October 1995, and we sort of end up in beginning of 2009. So you can see the volatility isn't constant. It changes over the life of an option. Let's say we wrote a long option, it's going to change as these sort of market crises happen. You can see this huge sort of double spike there. That's the Asian emerging market crash. Then things sort of calmed down quite a lot, and then suddenly Russia defaulted in 98, and that just suddenly the markets were in a complete panic again. So at those points, those sort of highs, options are very, very expensive. At the troughs, options are quite cheap. So that's a fascinating thing about this implied volatility, is that it is mean reverting. So over the long run, there's an average sort of level for the top 40 that seems to be around about 24-25% if you look at the long run average volatility. When it's much lower than that, it's going to climb back up to that 25% level. When it's much higher than that, it's going to come right back down to that average level. We can see sort of here around the 20% mark.
Yes.
That's where most of our results are sort of clustered. That's the average. Now, the fascinating thing about mean reversion is the further out of line it goes, the faster it comes down. So if it's way up above high, it's going to come down quite quickly. If it's way beneath it, it's going to come up quite quickly. If it's a little bit, it can mean revert quite a bit slower.
So that's pretty much what stock markets do. When they fall quite quickly.
Exactly.
When they rise, less so.
Exactly. So that tends to mean that because markets fall faster than they rise, implied volatility generally decreases when the market goes down. So we can see these different times, the peaks and troughs of when you would have bought and sold. If we look at it with the share price, this is the ALSI, that is the yellow graph. That's the share prices going up and down. We can see here they climbed to that absolute high, sort of 33,000 up there in May of 2008. Then they collapse right down. We can see implied volatility, it's a bit slow, a little bit of a lag, and then it shoots right up as the market collapses down to 16,000.
That was March 2009.
So March 2009. So I mean, even sort of end of 2008, we had some option vols at 60%. So I mean, that is astronomical. 60% when you've got that long run average of 20%. We're actually going to look at an example shortly that shows you how much that is. So what you're looking at is the long run average, and you're trying to buy options cheaply. The other thing you can look at is the historic volatility. What has the market recently done? Has it moved up and down? Has it been volatile? Has it been unvolatile? And whether it's returning to its long run sort of mean. So at the moment, there's not a massive amount of trade in our options market. And it's quite interesting because there are these two ways of looking at implied volatility. The one is historic volatility, incredibly low on the ALSI at the moment. The market really has been very, very quiet. And implied volatilities are also very low relative to their highs, but they're significantly above where that historic is. So if you're just looking at historic, it seems really expensive to buy options. If you're looking at the long run trend of going back to its average, in implied volatility, they're actually really cheap. So there are two different ways. You have these arguments between people sort of saying it's too cheap, others saying it's too expensive, depending on which way you're looking at it. So if we look at an option here, we've got here at 60% volatility. We've got a 16,000 strike price call from March 09 to June 09. If you bought that, you would have made an absolute fortune. But the problem is you've got 60% volatility. So that means We need over 3 months, the market has to move 12%.
Right.
Now that is a serious move. That would be one of our best sort of quarters in the history of the JSE for it to do 12%. That's because that option is at 60% volatility. Now if we look at a more sort of normal one, sort of at the current sort of prices, we get something like 20% for an at the money sort of call strike. Then the market needs to only move 4% in 3 months. So you've got to look at this implied volatility over time. Now, in the market, we call that Vega. Now, Vega is what happens in Rand terms to your premium if there's a 1% increase or decrease in volatility. So that is a measure in the Rand amount, what's going to happen to your premium revaluation. Will you have to pay in money if the volatility falls and you bought an option? Yes, you will. Will you receive money? If the option value increases due to an increase in volatility, you'll receive a very, very good profit. So it's another factor you really have to watch closely when you're trading options.
Just to take us into the broader picture at the moment, if we look at world markets where they are at the moment, people are feeling a bit conservative. They're waiting for things to settle. So what does that tell us in terms of volatility right now?
So the fascinating thing is that all around the world, volatility levels are really quite low. But we've got a very interesting term structure of volatility because in the short term, everyone's convinced everything will be okay because of central bank sort of backup for the markets. As soon as they tank and inflation looks quite low around the world, they're worried about inflation sort of increasing in the future. And part of that we're seeing is that longer dated options are more expensive than near dated ones, which is an abnormal situation. It's called an inverted term structure. So people are saying there will be risk tomorrow, but at the moment we think there's not much risk. So it's quite an uncertain situation we find ourselves in, and you can see that around the world by looking at these implied volatility numbers. One of the big ones is the SAVI we look at on the JSE, and the VIX, which we look at in the States.
Yeah. Okay, James, just coming back to that, the issue of the daily measure of volatility, is there anything else that can help us work that out?
There's a very, very useful shortcut. So we can see with our example that we've got, if we had a volatility of 60%, we can divide by 16. Now that's because it's the square root of the number of trading days in the year. So if we just divide by 16, we can see that we need about a move of about 3.75% each day for it to be more volatile over a year. So that gives you a good indication. If we look at the Aussie, like sort of when Japan had that terrible tsunami, market fell about 3%. Lehman Brothers, it fell about 3%. So what you're actually buying when you buy an option at 60% is you're saying there's going to be a Lehman Brothers or tsunami every single day for the rest of the year. That can't happen. The market just runs out of steam. Yeah. For a 20%, it's only 1.25% a day, which is much more feasible over the time period. So that's how you tell. Is an option cheap or expensive?
Great. James, thanks very much. What are we looking at next week?
Next week, we're going to look at sort of some differences between the on-exchange market and the over-the-counter market and the way things are traded in those two markets.
Super. We'll look forward to that. Thanks very much. We'll see you next time on Inside Options. Goodbye.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.